there, it's Tamika and Kirsty from Uploans, and we just wanted to have a chat with you about self-employed income. So many clients that we deal with at the moment have one or more people involved in the application who have self-employed income, and it's a bit of a pain, but it's actually significantly harder to work out borrowing capacity, but also your borrowing capacity will vary really widely across lenders. So Tam and I are going to talk about just the main things we want to be aware of. So when someone comes to me and they say, I've got a new business, what's the first thing we always think about as far as like ABN registration?
Yeah, so most banks will want to see your ABN registered for at least 18 months or even 2 years. So that's a really big thing. Just because you're a new borrower, though, it doesn't, or a new ABN, doesn't mean that you can't lend. And we'll deal with that a little bit further down the track in low dot kind of applications. And maybe there are some kind of exceptions that we can work through with some banks if you've been in the same industry and the like. But as a general rule of thumb, you need to have 2 years of full financials as a self-employed applicant to get a loan at the best interest rate at a mainstream lender.
Which can be so hard because you might have gone from doing something as a PAYG employee and then you might be doing exactly the same thing as self-employed. But what you've got to know is that banks do treat self-employed income more harshly in terms of there's a few more hurdles for us to jump over. So right now, when we're recording this video, it's May of 2021, and this video will probably be on our website for a while, but in May of 2021, what we need people to know is that we can't be basing your self-employed returns on 2019s with most of the lenders that we deal with. So what's the general cutoff point as to when you need to have had that New Year's tax return done?
So generally it's the 31st of December, which is a rule of thumb. So for now, we want to be seeing your 2020 tax returns prepared. And normally we would have appreciated that as of the 1st of January. And what that means is the bank is making an assessment on your income based on something that's quite close, a date that's quite close, rather than if we were using 2019 incomes. And we know that COVID actually has thrown a massive spanner in the works for self-employed as well. And banks are really starting to want to see really up-to-date financials. So we might, as well as asking for your financials, also ask for your BAS, and your BAS is an indication of how you're going year to date.
Right.
Yeah, exactly right. So it's giving the bank really up-to-date information on your financial situation.
So it used to be that banks would look really historically for self-employed income, and now they want to know right now because of the tumultuous year that we've had. It's sort of, that used to be one of the interesting sort of quirks of self-employed, that you could look at previous periods, but now it's like, we're going to look at that, we're going to look at what's happening now, we want to look at everything, and we're going to make sure that the bank really believe that they can, I guess, give you the money without putting you into risk.
And the other thing that the bank's then also asking for at the moment is 6 months of your bank statements. So not only are they looking at historical financials and your BAS, but they're also looking at your bank statements to make sure that it all matches up. So there's a lot of ticking boxes and a lot of extra work that's going on with self-employed applicants at the moment.
And it's really important then that you get your invoicing up to date if you are going to do an application, because I know that that's one of the things that with self-employed applicants that can fall by the wayside a little bit. But if a bank's going to be looking at your up-to-date bank statements, they're not going to care necessarily about your receivables that you haven't invoiced yet. So getting that all up to date. All right, so let's talk about how depreciation and interest add backs and even asset write-off, how that sort of impacts a self-employed application.
Yeah, so when you're self-employed, what I get a lot of people come to me with their tax return or their payslip, because some self-employed people still pay themselves a payslip. I'm self-employed, I still give myself a payslip every fortnight.
But the bank don't care.
No, because your overall self-employed income is what happened in your whole tax year between yourself, your company, any other directors or people that you paid money to who own your business as well. So the bank's looking at that as an overall. So there are some really simplified kind of applications that we can do just using your payslip, but mostly we have to use, the bank has to look at you as a whole, as you and your business. And
that best accountants, their job is to make you look as weak on paper as possible to save you as much tax. I mean, all within the realms of, truth and all of that sort of stuff. But what you've got to know is your revenue is not what the bank care about.
Yeah. So what the bank's really looking at, as well as your net profit and what you paid yourself, is your depreciation and also what debts you had that you paid interest on. And that's good because on the whole, banks will add that back as your income because they're non-cash items, or what we call non-cash items. A little bit confusing and starting to get a bit accounting. I'm probably losing some of you. What's really important to note is that the asset write-off rules that have been in place, where you can buy a car and you can write off your whole car against your profit for this financial year, the banks are looking at that very harshly. So they are not adding that back, but they're also, which means we can't include that as part of your income, as part of your profit.
So say for example, a builder goes out and buys a new ute. If the bank don't then add that back on, they're assuming that you're going to be buying a new ute every single year. So it's quite a harsh way to look at it.
It is. So we're having a few issues in servicing. There are some banks that are better than others, and again, that's our job to work out what's your personal situation. And you know what? You might be talking to Fred on the weekend, and he did this and this and this with his bank, with his self-employed stuff. But you know what? That's Fred, and that's his financial situation. Your financial situation, based on what your accountant puts on black and white on your tax returns and on your financials, may possibly be very, very different to Fred. So you actually can't compare what Fred did to what you're doing.
And even if Tamika or I are Fred's broker, we still couldn't talk to you about it. That's the best thing, isn't it? My friend Fred was able to do such and such. Usually we're not Fred's broker and we have no idea about Fred's situation, so yours can be completely different. And every lender has their own intricacies. Some lenders are amazing. So say for example, your business is on a real upward trajectory and your figures are increasing year on year. Some banks will look at the worst of the last 2 years. Some banks will look at the worst plus 20%. Some will average out the 2 years, and some will just use the strongest year if it was the most recent year. So choice of lender can be incredibly important as far as borrowing capacity goes there. Let's talk about JobKeeper. How are lenders treating JobKeeper? Because it's something that's impacted many businesses. So it's quite different across lenders, isn't it?
It is very different. So what we would all hope would happen is that a bank would recognise that JobKeeper was put into place to steady out your revenue, because during COVID your revenue dropped because you might not have been able to work, and JobKeeper came in just to fill that gap.
To make sure you could keep your employees and all of that sort of stuff.
You would hope that a bank would include that JobKeeper, because ordinarily you would have worked through that period and had that higher income. They don't. So what's actually happening is that JobKeeper is being stripped out of your financials.
Government stimulus.
Yeah, anything like that, the cash flow boost. That's all being taken out. So if you have a look at your net profit and then you take out those items, then we're finding that people's net profit are being affected quite dramatically, and that affects your maximum borrowing capacity, because the bank's just making that look like that's actually not income. Even though you had the same expenses that you had while COVID was on, and the JobKeeper was to supplement those expenses. Too bad, so sad.
And there are some exceptions to that rule. What we're tending to find is that the lenders that are adding that income in have been hit with an influx of borrowings, because brokers are clever and we know what lenders will do what. So that means that typically the lenders that are adding back that JobKeeper may fall into our lowest category of self-employed lending at the moment. So sometimes the lender that will do what you want might also take a lot longer than previously to actually get to that.
So if you are self-employed and you're thinking of purchasing, because what we're finding is purchases are being really held up if we have to go to these particular lenders, or this one particular lender, you 8 weeks or 12 weeks out from when you want to purchase, you already want to be coming and submitting an application, because that is our time frame, 3 months minimum to have your loan assessed if you're in that situation.
You need to go to that lender. And I mean, that's not bad advice for anyone out there looking self-employed or not. At the moment, some lenders are running very slowly. So obviously there's a lot going on in the world at the moment. India is being incredibly hard hit, and a lot of the big banks do have processing or settlement or solicitor teams who work out of India. So of course, some banks have slower timeframes at the moment. Some banks with completely onshore teams have slower timeframes at the moment as well. So the very best time to get pre-approved for a property, if you can do, is before you start looking. Doesn't mean you have to, but far out, it makes the journey a lot easier for you and saves us a few grey hairs along the way. Now, you mentioned low doc before. So there's some lenders who will look at a situation where your accountant can declare income, or there's alternate ways of verifying income other than showing 2 years worth of tax returns. Talk about that a little bit.
Yeah, so there are some lenders that we can use who you might have had a bad couple of years and you've had a really fantastic year to date. They'll have a look at your last 6 months of BAS. They'll verify that on your bank statements. Some will ask for an accountant's letter, some won't, because your accountant doesn't always want to sign those kind of letters. So there's a few different lenders that we have that will use different information depending on the information that you've got available. But if you've had a really, really great year to date, you haven't got it on paper yet, it's not historical, we can look at a low doc kind of option. And also if you haven't been trading. So the rule of thumb is you need to be trading 6 months with your ABN. So a low doc can assist anytime after 6 months on your ABN. And that's great because we can show your 6 months of history that you've got on your BAS and on your bank statements, and then take that to a lender and get a loan approved. So what we generally find is those lenders will have a higher interest rate.
High fee structure as well, so risk fees. Yeah,
that's right. And generally we can't go higher than an 80% loan to value ratio, which means you have to have 20% deposit plus your costs. So you have to have a bit higher in your deposit as well.
And if your deposit is larger, that can bring down those rates and fees as well. So with low doc options, 70% is typically better, 60% can be even better. So you can open yourself up to better interest rates that way.
And the other thing is that those, you're not going to be stuck on, that's not a 30-year loan term for you. So what that is a short-term gap to get you to 2 years full financials. So you might need to be on that loan for 18 months, 2 years,
yeah.
Whatever you need to get you then the financial history to get you back into a mainstream lender at a decent lower interest rate.
Yeah, and it is important to note that that's not a forever sort of thing, but it does depend on what your financials look like at that stage. So you still have to be really concentrating on making sure that what we're seeing on paper then matches up with something that's going to enable you to get to your next sort of journey onto a different lender. One thing I hate being asked, because it's an incredibly difficult question, is how much do I need to be earning in my self-employed income to be able to get this loan? Because it's not here's this figure, it's what's happening with your depreciation and your interest and JobKeeper and all that sort of stuff. So if you ever ask a broker that question and they're not able to provide you with a specific answer, it's because it's not a payslip. It's more complex than that.
Yeah. And
the more complex your structure is behind the scenes as well. So someone might be self-employed and they are a sole trader with a very simple structure. Carrie, our other broker, Tamika and I, we all handle self-employed clients. Once it gets to a certain level of sophistication and size, that's where Tamika's really our self-employed specialist. She not only has a background as a commercial banker, so she can look at business lending, commercial lending, and residential lending, but her area of expertise is complicated self-employed, and we're very happy to have her doing that. So if you do have a need for someone who is a self-employed specialist, you want to have a chat with them, Tamika at Up Loans is your girl. Is there anything we've missed? Anything we haven't spoken about?
I think you might feel like self-employed people are getting a really, really hard run. But at the end of the day, I guess the difference is your self-employed income can be, do you know my favourite word? Lumpy income.
So you could do all your invoicing in summertime,
that's
for
right.
example.
So
yeah.
your income can be up here, but it could be down here. So at all times of the year, that can change, which means it's lumpy. Sometimes it's big and sometimes it's small, and that's really hard for a bank, and particularly a bank that just focuses on mortgages and doesn't really understand the intricacies of how a business earns money. That can be really hard for them to get their head around, and part of what that is risk. How much risk are you to the bank? And at the moment, because of COVID and because of the uncertainties,
the world,
banks see self-employed people as a little bit more risky. And that's just what we have to deal with, and that's our job. And some banks are better at it than others, and that's also our job, to get you to the bank that sees you as the best risk.
And that's the thing,
that's
like
what a broker does.
Our job is not rate shopping. It's not like who's going to get you the best interest rate. First of all, it's who's going to do what you want to do. If a lender's not going to give you a home loan, it doesn't matter if they've got a 0% interest rate. It's who's going to do what you want to do within a time frame that you want to do, and making sure that it works for you. So if you think we can help you out, please let us know. Please note that we do have a minimum level of documentation that we need before we see you. Otherwise, the first meeting is a waste for you and we're not able to help. So just know that there are some things that we're going to request prior to meeting with us so that we can do our job best and hopefully find a solution for you.